Who actually moves the price in the market? This is a question that many people ask themselves, especially those who are just starting to trade. Have you ever noticed how the price goes against you right after opening a trade? Maybe it seems like someone is watching your every move. Let's figure out today who is actually pulling the strings and making prices move up and down. But before we find out who is behind the price movement, don't forget to put a like on this video and subscribe to the channel. This will help you not to miss our new videos and also motivate me to keep sharing useful information about trading and investing with you. First of all, it's important to understand that the price in the market is not just driven by some abstract buyers and sellers. In fact, there are certain groups of participants behind it, each influencing the market price in their own way. 1. Central banks and governments. Central banks, they are like the conductors in the orchestra of finance. Imagine that they control the musical instruments, setting the tone for the entire market. They set interest rates, which is like a volume control that can make money cheaper or more expensive for everyone else. When they decide to raise or lower rates, it's like banging a drum. The market reacts immediately, and the value of the currency can change instantly. 2. Large institutional investors. Banks, hedge funds, investment companies, and pension funds are the real giants in the market. They are like elephants in a china shop. When such a player enters the market and buys a huge position, the price rises and everyone notices their presence. And when they decide to exit the position, be sure that the price may collapse just as sharply. So when these guys start to act, small players try not to get under their feet. 3. Market makers. Market makers are like the masters on a carousel. They control the traffic so that everything spins and no one gets bored. They ensure liquidity, in other words. They make sure that there is always someone in the market ready to sell or buy an asset. Their goal is to keep the spread, the difference between the buy and sell price, under control so that everyone is willing to play the game. Sometimes they may manipulate the price within small movements in order to capitalize on this spread. 4. Retail traders. And of course, you and I are the retail traders. We are like small heroes on a big battlefield. We are trying to catch our favor against the actions of the big players. Our influence is smaller, but that doesn't mean we don't play an important role. We can influence short-term fluctuations, but we can rarely reverse a global trend. Our task as retail traders is not to change the market globally, but to get stable profit from it. Exactly for this purpose, I have developed the MiloBot PRO Expert Advisor. It is an automated trading advisor, which allows retail traders to use a well-thought-out strategy without constant monitoring and market analysis. An indicator of the strategy's reliability is the fact that the developer's real accounts work with deposits totaling over $100,000. In over 4 years of trading, the Expert Advisor has increased the deposit by 1,510%. MiloBot Pro can be used on MT4 and MT5 platforms. If you are interested in purchasing this Expert Advisor and start to use it in your trading, go to the MQL5 website. The links will be in the description below this video. Now, when we know who is in charge in the market, let's figure out how price movement occurs. It all comes down to supply and demand. Imagine a market where apples are being sold. If everyone wants to buy apples and there aren't enough apples, the price goes up. If there are lots of apples and only few buyers, the price goes down. It works much the same way in a market. When demand is greater than supply, the price goes up. When supply exceeds demand, the price goes down. But in practice, it is more complicated because there are big players who can seriously change the ratio of supply and demand. To understand how big players can move the price, let's look back at one of the most famous examples in the history of financial markets, George Soros' bet against the British pound in 1992. This event became known as Black Wednesday, and it perfectly illustrates how one man was able to break an entire economic system. Picture the scene. The United Kingdom, 1992. The government is trying to keep the exchange rate of its currency within a certain range. The Bank of England is desperately struggling to maintain stability, but George Soros realizes that the pound is highly overvalued, and keeping it at that level won't work for long. He saw the cracks in the system and decided to strike exactly where the system was most vulnerable. Soros started selling pounds against the German mark, literally betting billions of dollars that the pound would fall. The pressure on the market became incredible. It was a real battle between the Bank of England and George Soros. By morning, it was settled. The Bank of England capitulated, had to withdraw from the ERM, and devalue the pound. George Soros ended up making about $1 billion in just one night, and he began to be known as the man who broke the Bank of England. This was the moment when one man won the battle against the entire system. If you're interested in learning more about who George Soros is and his investment strategies, I recommend you to watch our video on the topic Financial Geniuses, comparing the approaches of Buffett, Soros, and Peter Lynch. In this video, we go into detail about what strategies the world's best investors use and the difference between their approaches. The link will be in the description. Don't miss it. But how do the big players move the price and create false moves? Now let's talk about what other strategies the big players use to move the price and even manipulate the market. 1. Accumulation and allocation. Large players, such as institutional investors, do not buy or sell assets in a single moment. They use accumulation tactics, where they gradually buy large amounts to avoid moving the market too sharply. When they finish accumulating a position, distribution begins and the price can move sharply up or down in their favor. 2. Traps for retail traders. Often the big players create false moves to make retail traders make mistakes. For example, when the market pretends to break an important level, many retail traders start to enter the market thinking that a new trend has started, but then the price suddenly reverses, leaving everyone trapped. This is a classic tactic known as a false breakout. Now that we've figured out who and how moves the price in the market, here are some tips to help you use this knowledge in your trading. Keep an eye on volume. The big players can't hide their actions. If you see unusually high volumes, it's a sign that something big is happening in the market. Don't fall for false breakouts. When you see a sharp breakout of a level, do not hurry to enter the market. Often it is just an attempt to shake out retail traders. Analyze the news, but do not panic. News can move the price sharply, but big players use such moments for their own purposes. Keep an eye on what is happening, but don't get emotional. So, the market is not just the sum of buying and selling. It is a complex structure influenced by big banks, hedge funds, market makers, and retail traders. They are all involved in creating price movement, and each has different objectives. Understanding how the big players operate allows you to better understand the market and avoid the traps that are often left for smaller participants. Write in the comments what you think about the actions of the big players and how you take their influence into account in your trading.